In the winter of 2019, I found myself trying to narrow my list of investment strategies down to about 10 or so specific portfolios. I had some extra money at the end of the year and I wanted to do something fun with it. My idea was to pick 10 of my favorite portfolios and invest $1,000 in each of them on the first trading day of 2020. Then I would sit back and watch what happened. No buying, no selling, no rebalancing. Turned out it was way too hard to pick just 10, so I ended up with 13 selections. Number 1, the Blue Chips portfolio. Number 2, Dogs of the Dow. Number 3, Dividend Dogs. Number 4, All-Weather. Number 5, Permanent portfolio. Number 6, Golden Butterfly. Number 7, the Holy Talmud. Number 8, Couch Potato. Number 9, the Core 4. Number 10, the Boglehead 3 Fund portfolio. Number 11, the Simple Path to Wealth. Number 12, Ultimate Buy and Hold strategy. And number 13, the Dow Jones Industrial Average equal weighted. So how did these strategies do in 2020? Well, stick around and let's find out.
When you set up a portfolio, you're supposed to build into it the worst loss. And to limit that loss to whatever level that is, you got to put in the right amount of fixed income. And then you have to get out of the business of trying to second guess the market.
Before we dig into our portfolio results, I want to spend a few minutes talking about risk. As I record this in December of 2020, the U.S. stock market is back to an all-time high as drug producers begin deploying a pandemic vaccine. There's a lot of excitement in the markets right now, and very few people are considering their risk exposure. I want you to imagine that you are a typical investor with a $100,000 portfolio. Let me ask you this question, and I want you to think seriously about your answer. How much of this $100,000 portfolio can you realistically bear to lose? Would you be okay losing $50,000? How about $46,000? Take a look at this table. This is a classic asset allocation matrix. This table spans the past 40 years, and it shows us the average annual return and maximum drawdown for each type of asset allocation. If you're in a 100% stocks portfolio, you need to imagine what it would feel like to see your balance reduced from $100,000 to $50,000. Look over these values and try to decide what level of risk that you're willing to take. If you think the maximum loss that you can realistically withstand is a 25% loss, for example, then you should be targeting a 50-50 portfolio. Please understand that losses are detrimental to your portfolio in a big way. This is a performance chart for the last 2 years, 2019 and 2020. It compares a 50-50 stock and bond portfolio with a 100% stocks portfolio. Notice how the 100% stocks portfolio finished slightly ahead of the 50-50. That's great, but it wasn't a foregone conclusion that this is what would happen. Notice how the blue line, which is the 50-50, is nice and smooth, whereas the red line is erratic. The 50-50 maximum loss was 4%, whereas the maximum loss for the all stocks was 20%. If you sold out of the market in March, you had to put your money somewhere, and wherever you put it, you would have had to have earned a return of at least 25% just to break even. My point with all this is just to say that losses matter. They really matter. Whenever possible, you should always strive to invest in portfolios that produce the highest return given the specific level of risk that you can personally tolerate. Okay, so now that that's out of the way, let's take a look at the results of the challenge. How did we do? How did these portfolios do? This is a Google Sheets scorecard that I created to monitor the project result. Keep in mind that this is real money, not paper trades. This experiment is a lot less interesting if all the data is theoretical, so we do have some skin in the game here. But do note that these returns are just capital gains. There's no dividends or interest, so any portfolio that relies heavily on dividends or interest payments may be a bit understated. Again, this is only 1 year performance, so it shouldn't be that substantial. The gray columns that you see are not part of the actual portfolio, they're just benchmarks. I tried to peg most of the portfolios to a fair benchmark to see if our portfolios did better or worse than a similar benchmark investment would have returned. The columns that we care most about are the percentage of gain-loss and the standard deviation. To measure which portfolios perform the best, we want to find the portfolios that produce the highest return at the lowest standard deviation. Again, keep in mind that this is just a single year and you can't judge an investment strategy by the performance of a single year. This is just a fun experiment for our own amusement. Okay, so portfolio 1 is what I'm calling blue chips. These are just stocks that I picked that I felt were healthy, stable US companies. As you can see, these stocks got killed. It ended up only down around 4%, but for most of the year, it was sitting around an 18 or 19% loss. Portfolio number 2 is the Dogs of the Dow strategy. I haven't covered this one yet on the channel, but I do plan to cover it in season 2, so be sure to subscribe if you want to see that. This strategy has actually done really well over the last decade, but 2020, it got crushed. It's a loss of about 12%. The Dogs ETF benchmark did do a lot better, but that 34% standard deviation is just insane volatility. Portfolio number 3 is the Dividend Dogs strategy. This is usually a great strategy for people who need investment income, but this year dividend stocks were crushed. A loss of 13% here. Also, a really high 30% standard deviation value. It is interesting to note that the ETF benchmark, ticker symbol NOBL, that one did do a lot better, but it's got 100 different dividend stocks in it, not just a handful. Portfolio number 4 is Ray Dalio's All-Weather. This one did lose to the 40-60 benchmark portfolio, but it is an overwhelming winner on the merits of risk to reward. We received 13% return for just 8% standard deviation. This is a pretty fantastic result. Portfolio number 5 is Harry Browne's permanent portfolio. This portfolio just killed it this year. We got 13% for just a 7.8% standard deviation. I don't have the metrics in front of me right now, but my guess is that 2020 has got to be one of the best years in this portfolio's history. I've been watching the permanent portfolio for decades, and this strategy usually returns 5 to 7%. So this is a real big win here. Note how the benchmark ETF returned less for almost 3 times the risk. That's really interesting. I might have to investigate that. Portfolio number 6 is the Golden Butterfly. The value stocks got crushed this year, but it looks like the S&P 600 Value Index did make a comeback later in the year because it only ended up being down about 35 basis points. So pretty great results here. 12% standard deviation for a 13% return. Portfolio number 7 is Robert Gibson's Holy Talmud portfolio. This portfolio is working exactly the way it's intended to. Real estate had a pretty bad year, but stocks and bonds had a good year. So the portfolio balanced itself out for a return of about 449 basis points. Portfolio number 8 is Scott Burns' Couch Potato. To be honest, this one really shocked me. In fairness, this is my modified version of the couch potato. This is the one that uses long-term U.S. Treasuries rather than an aggregate bond index fund. But wow, pay attention to this result. Notice how long-term Treasuries beat the S&P 500. Let me say that again for all the people who keep parroting this idea that bonds are worthless. just because they don't pay interest anymore. 20-year long-term U.S. Treasuries returned a whopping 15%, whereas the S&P 500 returned 14%. This portfolio returned an astonishing 15% for just 12% standard deviation. This is frankly an amazing result. Portfolio number 9 is Rick Ferri's Core 4 portfolio. This one did suffer a bit from poor real estate holdings, but it returned 10% for a 20% deviation. That deviation is still a bit high, but it's an okay showing. Portfolio number 10 is Jack Bogle's Boglehead 3-fund portfolio. Pretty much the same as the Core 4, but since it lacks that 8% real estate, it wins by about 142 basis points on the year. Portfolio 11 is J.L. Collins' Simple Path to Wealth. This one was a pretty wild ride throughout the year, but it ended up doing very well with a 14% return. Again, note how those long-term U.S. Treasuries beat the S&P 500. Portfolio number 12 is Paul Merriman's Ultimate Buy and Hold strategy. We haven't covered factor investing yet on the channel, but if you want to see that, be sure to subscribe because I'm definitely going to make a video on this technique. The results here look okay, but this portfolio gave me a heart attack all year long. At one point, it was down as much as 35%. It's got small caps, it's got value, it's got real estate, it's got foreign stock, it's got emerging markets. It's got all those asset classes that had a very, very tough year. And this portfolio in particular, it really took some determination to stick with. It ended up the year in the green, but this one has got to go in the L column for its heart attack factor. Portfolio 13 is a strategy where we take the Dow Jones Industrial Index, but instead of price weighting it, we equal weight it. You put 3% of your balance into each position, split across 30 positions. This portfolio was in the red for most of the year, but surprisingly, it did rally into the green here at the end of the year. We did lose to the benchmark overall, but this one was okay. This is another example of how taking higher risk doesn't always lead to better performance. In fact, sometimes it can lead to bad underperformance. Okay, so after having reviewed the results, it's clear to me that we have an undeniable champion here. I think the best overall portfolio of 2020 goes to Scott Burns' Couch Potato portfolio. This one really surprised me. My mind just can't comprehend how a medium risk, 50% stock and 50% bond portfolio can produce the highest return of all the portfolios. This just goes to show you that not all bonds are created equal. If you pick bonds that are loosely or negatively correlated based on the correlation coefficient, then you can produce a result that both gives you protection and high returns. Now, the best, safest portfolio of 2020, I think, goes to Harry Browne's permanent portfolio. In terms of pure risk to reward, this portfolio had maybe its best showing ever. Gold, long-term U.S. Treasuries, and the S&P 500 all had huge years. And when you put all those asset classes together, you end up with a truly, truly amazing year. Whew. Well, that was a lot to chew on. As we close out this season, just let me say that I really appreciate all the feedback and the support that you guys have given me. It really does mean a lot. Just a heads up, every portfolio that we covered this season is in the video description if you'd like to invest in them. Now, if you do decide that you would like to invest in some of these portfolios, please consider using my M1 affiliate link that's in the video description. I will get a very small commission if you do that. It's not a lot, but every little bit does definitely help out the channel. As always, feel free to reach out to me if you have any questions or concerns. I really hope that you guys have a Merry Christmas and a Happy New Year, and I'll be seeing you again in 2021.